A very warm welcome to all the students. Welcome again in my session, and I am Dr. Neha Verma from AKGIM Ghaziabad. Now in this session again we are going to discuss another topic of investment analysis and portfolio management. And to continue with the same topic that we were discussing in the last session, equity valuation, I will be discussing some more models which are used by the investors for equity valuation in the stock market. And the models that we are going to discuss in today's session is 2 and 3 stage model, earnings multiplier approach and PE ratio. Now in the last session, in order to just have a little bit of revision, we discussed two of the main models which are used in stock valuation. The first one was dividend discount model and the second one was constant growth model. Now in addition to these two models, there are other models as well which is present in the stock market and is widely used by analysts and investors for equity decision making. And those models are 2-stage model, 3-stage model, equity multipliers approach and PE ratio. And with the discussion of all these models, we will be able to have a complete picture and understanding of how equity valuation is done in the stock market. So let's just quickly begin with the topic. The first discussion in this particular topic will be talking about 2-stage growth model. Now this model basically divides the constant growth rate of dividends into 2 stages, and this model relies on the fact that whenever any equity valuation is been done by the investors and equity investment is been made by the investors in the market, the growth rate, which is constant in nature, is actually divided into 2 parts, 2 phases, and on the basis of these 2 phases, hence the name of the model is been given by the researchers, which is 2-stage growth model. So quickly just let's discuss what are the 2 stages of growth in the case of equity investments. The first stage is the stage of extraordinary growth or decline. So yes, this stage of model of equity valuation believes that the first stage of equity investment comes a phase where the investors they experience an extraordinary growth or an extraordinary decline in the market in the equity investment. And the second phase here is the phase of constant growth period. Whenever there is an extraordinary response of the equity investment in the market for the first phase, then after that phase enters the second phase of the equity investment for any investors in the stock market, and that phase, the second phase, is categorized by a phase of constant growth rate of the dividends in the equity investments. So that is whenever any investor invest in the equity shares, the first phase comes with the equity investment, which is the phase where the investors experience an extraordinary growth, or for that matter on the contrary, they may also experience extraordinary decline in the growth rate of the dividends. And when the second stage enters in the equity investment, here the growth rate becomes constant for the dividends throughout the perpetuity of the equity investment. So through the perpetual existence is there for the equity investment. So as soon as to all the years, all the number of years, the equity share will be in the market. In the second phase is the growth rate of the dividend will become constant. So this is the model, and this is the formula basically that you can see on the screen. We use this model for equity valuation in the case of 2-stage model. So here the formula denotes D0 1 plus GS to the power T divided by 1 plus RS to the power T. This particular phase is the phase 1. It is the phase 1, and the rest of the phase is phase 2 for the 2-stage model in the case of equity valuation. So the first stage here is categorized by extraordinary growth or extraordinary decline, and here the factors that we use for the valuations are D0, which is the cash dividend of the current year, 1 plus GS. Here GS is the normal growth rate, the normal growth rate in which there is an increase in the growth of the dividends in the first phase of the equity investment. The denominator over here is 1 plus RS. RS is the required rate of return for the time T. This T here denotes that for the entire phase of which the equity investment will experience an extraordinary growth or decline, that particular total amount of time will be considered as time T in phase 1. Then when the equity investment actually enters the second phase, which is the phase of constant growth of the dividends, this is the term which is used to evaluate the equity. Here Dn plus 1 is taken, which is dividend of the 5th year plus the growth rate of the 6th year, the next year. we can say. So, n here we are talking about the n, the dividends in the n year. N year is the year which has been ended in phase 1, and plus 1 is the growth rate of the next year, where the next phase actually begins in the equity investment. Then divide by RS minus GN. GN is the constant growth rate. Then RS here again is the required rate of return, and N is the number of years in which the entire equity investment is been made, and this is the period in which the equity investment reaches the second stage of the valuation. So, this will be more clear in this particular example, where we are going to discuss how two-stage model is actually applied in the stock market and is used for decision making of the investment by the investors. So, let us just quickly go through the question. A report of July 2018 states that rate of return of National Fertilizers Limited stocks are for the past 5 years is 18.58%. This is assumed to continue for the next 5 years, and after that R is assumed to have a growth rate of 10% indefinitely. So, here by the help of this example, this particular statement, we can easily make out that this is the question of two-stage model, wherein in the first stage it is assumed that the growth will continue for the first 5 years, and in the next indefinite period the value of R will be 10%. Then the dividend paid for the year 17-18 is 18%. This is the current dividend which is given for the current year as per the data, and the dividend is 18%. Then required rate of return is 20%, and the price is 18 on 4/7/18. Estimate the stock price and assume the face value of rupees 10. So, again if we read the question entirely, then we can see that the growth rate of the dividends is divided into two categories, into two phases, and hence we can easily make out that this is a formula for, this is a question for a two-stage growth model of equity investment. So, let us just quickly, the first step of numerical solution of any of the models in stock market, the first step is to identify and to extract values of the terms which is given in the question. So, the values which is given in the question is dividend, that is D0 18%, which is 1.8. Then GS, which is the rate of return in the growth rate in the phase 1, it is 8.1858. Then GN, the normal growth rate for the entire perpetuity, it has been given as 0.1. Then the rate of return, the required rate of return is given as 0.2, and then N is given as 5 years. Now, let us just basically discuss that how this particular question will be solved in equity investments. So, what I have done over here is I have divided the entire formula into 3 parts, and this is the 3 parts exactly which has been mentioned in the question over here. So, I have just divided all these 3 parts into 3 categories, and then we will combine after the solution of all the 3 parts of equity investment. We will just combine the formula on a whole to get the final answer of equity valuation. So, let us just discuss how it is solved. The first portion of the formula here says D0 1 plus GS whole T divided by 1 plus RS whole T. So, here we will put the values that we have extracted from the question. D0 given is 1.8, then 1 plus GS. GS over here is 0.1858. So, it will be 1 plus 0.1858 to the power 1. Then divide by 1 plus RS, which is 1 plus 0.2, because the value of Rn is given as 0.2 to the power 1. Now, here in this first phase of the growth model, we will calculate the value of the first portion or the first phase of the model for the entire period of which the first phase actually takes place in the equity investments. So, we can see that the first phase, it lasts for 5 years. So, the calculation of the first phase in the formula will be for 5 years. So, this is the terminology for 1 year. Similarly, the same term will be written for second year, third year, fourth year and fifth year, and for that, with that we will actually calculate this entire term for the total of 5 years for which phase 1 lasts in the question. So, similarly, this is the calculation for year 1. For year 2, the same calculation will be done, and the power will be the value of power will become 2 from 1. So, let us just write the equation over here. It will be 1.8 1 plus 0.1858 to the power 2 divided by 1 plus 0.20 to the power 2. Similarly, we will add for the third year, then we will add it for the fourth year, and then we will add it for the fifth year. It will be done for the entire 5 years for which the entire first phase lasts in the question. Then coming to the second phase, now this is the solution of the first phase. Now we will calculate the value for the second phase. For the second phase, the first term is dn plus 1 divided by rs minus gn. Now dn plus 1 here actually means that dn is the dividend for the last year of phase 1 and plus 1 is separate over here, which is the growth rate of the next year, which means that if we talk about the dividend for the fifth year, this is the dividend for the year from which the phase second has been entered into. So this is the dividend of the year where phase 1 actually ended. So phase 1 ended at the dividend value of 5. So it will be the dividend for the fifth year more specifically. So it will be 0.18, 1 plus 0.1858, which is the value of the fifth year, and plus we will add the growth rate of the next year from which actually the second phase of the model it enters. So this will be the growth rate of the sixth year. So we will calculate dn separately, and then we will multiply the growth rate of the sixth year with this dn in order to get the value of dn plus 1. So this is the terminology that will be used in the question. Then it will be divided by rs minus gn. Rs minus gn over here is the value of rs, as in the question was 0.2, and then the value of gn is 0.1. It will be divided by 0.2 minus 0.1. So this is the value of how dn plus 1 divided by rs minus gn will be calculated in the case of phase 2 in the equity valuation two-stage growth model. Now again, the third terminology in the formula is 1 divided by 1 plus rs to the power n. Here the value of 1 and 1 will be same. Rs given in the question is 0.2, and to the power n, which we have already seen that the value of n over here is 5 years. So it will be to the year 5. So with this values we will calculate the value of the third terminology. Now once the formula the values of all the three factors have been calculated, it will be again put into the original model. The original model says the first value plus second value multiplied by the third value. So similarly, after calculating the values for here number 1, number 2 and number 3, we will put the values in the initial model which is used for two-stage growth model. So it will be 1 plus 2 multiplied by 3, and with this calculation we will obtain the value of equity shares by the help of two-stage growth model, and the calculation will lead to a value of 27 rupees 343 paise. So this is the amount, this is the price that we have calculated of the equity value of the equity shares on the basis of two-stage growth model. So this is how two-stage growth model actually works in the case of stock valuation. Similarly, if we talk about the next model which is used for equity valuation widely by the investors, it is three-stage growth model. Now three-stage growth model is one step ahead of the two-stage growth model, and this model basically assumes three factors: that while equity investment is being made by the investors, there are those equity investment is divided into three phases of growth of the dividends in the stock market. The first phase is assumed to be a phase of constant growth of dividends in the equity investment. The second phase categorized by the linear decline of the growth of the dividends in the equity investment, and the third phase is categorized by the perpetual existence and perpetual growth rate of the dividends. So it is further explained in this particular a chart which actually shows the three-stage growth model. Here we can see that in the first phase the value of the dividend it becomes constant. Then in the second phase it declines, and this decline is always linear in nature. Then in third phase again it grows and it remains constant for the perpetual existence of the equity investment. So this is the categorization of how 3-stage growth model it works in the market. Now quickly let's just go through the model. Now this is the model which is used for 3-stage growth rate equity valuation, where this is the stage 1, stage 2 and stage C. These are the 3 stages where the model has been divided very much aptly for equity valuation by the investors in the stock market. So here again the terminologies are very much same as it was used in the 2-stage growth model. Let's just quickly move on to the question, and it will be more clear that how this model is actually used in practicality and most widely by the investors in the equity valuation in the stock market. So this is an example of 3-stage model. By the information alone we can make out that the question is of 3-stage model. Now in the question, whenever it comes in the examination and whenever we are actually given a situation to solve the equations or the formulas or the models of stock market, we have to identify by ourselves, just on the basis of the information given in the question, that what model will be applied in the valuation. So in the question, if we will read it very carefully, we can see that there are 3 phases being given in equity investment, and on the basis of this information we can easily conclude that 3-stage growth model will be applied in this particular question. The question here says that ABC is assumed to grow at a rate of 10%. After 4 years, the growth rate of dividend is assumed to decline linearly to 6%. After 7 years, the firm is assumed to grow at a rate of 6% indefinitely. So we can say for the first 4 years the growth rate is 10%. After 4 years there is a decline, linear decline of the growth rate to 6%. Then after 7 years the growth rate becomes consistent at 6% indefinitely. The next year dividend is rupees 2 and the required rate of return is 14%. Find the value of the stock. So this is the, again we will just make out the same thing while solving the question. We will extract the values from the question which has been given to us. So these are the values which are given: D02 are 0.14, GA, which is the A is growth rate, that is the growth rate of phase 1, it is given as 0.10. Then GN, which is the growth rate of phase 3, it has been given as 0.06. Then GB, the growth rate of the second phase, which has a linear decline. I am repeating, just pay attention to the word linear decline. There is a decline of the growth rate from 10% to 6%, and the decline is linear in nature. So linear decline means that if we talk about the growth rate in the second phase, the growth rate will become will actually decline from 10% to 6%, leaving the rates as 0.09, 0.08, 0.07, 0.06, because there is a linear decline from 10% to 6% in the second phase of the model. Similarly, the value of B, which is given over here, is 7 years. B value 7 years is actually the starting of the second phase. Now this again we will divide the whole formula into 3 steps, into 3 parts. We will calculate the values individually and then we will combine the values in order to get the final value of the equity investment. So in step 1, which lasts for 4 years, phase A, this is the term for B and for C. So again let's just quickly go through how it is solved. If we talk about the step 1, which is the phase A for 4 years, we will just put the values in the formula and we will have a calculation for the entire 4 years, which lasts for the stage 1 or the stage A. So this is the value 2, 1 plus 0.1 to the power 1 divided by 1 plus 0.14 to the power 1. This is for 1 year. Similarly, like we have discussed in the previous model, we will calculate this particular terminology, this particular value for all the 4 years for which phase 1 lasts in the model. So for up till 4, we will just calculate the value, then we will obtain the value from stage 1. Then in stage 2, it will be dt minus 1, 1 plus gb divided by 1 plus r. Now this stage is from 5th to 7th years. So the calculation here will start from 5th year and it will go till 7 years in the model. So here we can see, we will just put the values first of all in the factor, in the variable. 2 1 plus 0.1 to the power 4, 1 plus 0.09 divide by 1 plus 0.14 to the power 5. Now here this variable will first be calculated for the 5th year, which is the starting of the phase 2. So 5th year is starting, that's phase 2 starting from the 5th year. So for 5th year the value will be dividend of 4th year plus the growth rate. So when the dividend of 4th year is considered in the model and it is adjusted with the growth rate of the next year, it becomes the dividend of the current year, which is the 5th year. So this is how we will write the value of calculation of dividend for 5th year. And since it is a linear decline, do not forget to remember that there is a linear decline in the growth rate. So after 4 years, for 4 years the growth rate will be 10, and for 5th year the growth rate will decline linearly. So for 5th year the growth rate becomes 0.09. Then in the 6th year there will be again linear decline. So value of dividend for the 4th year plus the value of 5th year linear decline and the 6th year linear decline will be considered to adjust the growth rate for the dividend value. Similarly, for the 7th year, when we will calculate the dividends, it will be 4th year dividend plus 5th year decline, 6th year decline and 7th year decline in the rates. When after adjusting all these values, we will get the solution of phase 2 and it will be marked by the number 2 in the calculation of variable. Similarly, the step 3 from the step 3 here the phase has began from the 8th year. So here we will calculate the value of the phase 3 with the help of these values. Again just we have to put the values over here and then we have to put the values of the denominators. In the numerator you can see that dividend of the 8th year is required. So dividend of the 7th year from here, this is the 7th year dividend, we will just take it as it is in the value and then we will adjust the 7th year dividend with the growth rate of the 8th year in order to obtain the value of dividends of the 8th year. So 8th year there is a linear decline again, so the value will be 0.06, the growth rate will be 0.06. So with this value we can obtain the value of the growth rate of the dividends of the 8th year and then we will divide it with the denominator over here. The values are already given in the question and you can calculate step 3. Now as the model suggests, here by adding 1 with 2 with 3, you can actually obtain the value of the entire model and the value will be rupees 33.59. So the simplest way to calculate the values of equity valuation in the case of 2-stage growth model or in the case of 3-stage growth model, we can easily do it by actually dividing the models into various steps. You can calculate the variables, the factors individually and then you can combine all the values together in the end in order to have a hassle-free calculations of all the 3 stages model. So this is how the calculation of 2-stage and 3-stage model is done in the equity valuation by the investors in the stock market. Now moving ahead, there are 2 more topics left for the discussion. The next topic is earnings multiplier approach. Now earnings multiplier approach is one of the another very much easy approach for the calculation of intrinsic value in equity valuation. Here the investors, what they do, they basically calculate the earnings multiplier ratio in order to calculate intrinsic value. They compare the value with the market value and they take investment decision. Now this particular approach is very much widely popular in the stock market and and also among the investors and the analysts, because of the reason that this calculation is very simple as compared to the present value through 2-stage model or 3-stage model. Now as we have already discussed, the 2-stage model and 3-stage model are very complicated in nature in order to calculate the intrinsic value, but multiplier approach is one of the way in which the calculation is done on the basis of simple calculation of EPS, and here the EPS is calculated by the investors with not much complications as was in the case of other models of equity valuation, and therefore this multiplier approach is used very much popularly in the investors and in the analysts in the stock market for taking equity investment decisions. here in this multiplier approach, what happens is basically the investors, they estimate earnings per share for the year ahead. That is, the EPS is calculated for the future on the basis of certain predictions, and on the basis of that prediction of EPS, investment decisions are undertaken by the investors. So that is why this model is used by 75, more than 75% of the investors in the market. And there was also one survey which was conducted in the stock market, where the analyst, they believe that other models of equity valuation is very much complicated as compared to the multipliers approach, and this approach was very much popular, again for the fact that it is very, very simple to calculate. So this multiplier approach, you just have to calculate EPS on the basis of certain future predictions, and then equity investment decisions can be easily undertaken by the investors. So moving on to the PE ratio. Again, PE ratio is another method which is used for equity valuation, because of the fact also that there are certain cases where dividends are not paid by the companies, and also there are certain situations where EPS as a measure is not given for for a particular company to be calculated in the model, in the valuation purpose. So therefore, PE ratio is calculated by the investors where all these limitations are present in the valuation purpose, and PE ratio also gives a certain very much reliable idea that whether investment should be made by the investors in the equity shares or not. So for PE ratio calculation, this is the model that we used. Simply this model is been obtained on the basis of the constant growth model that we have discussed in the previous sessions of equity valuation. This was the model. Here both the sides has been divided by E, and by earnings, by dividing both the sides by earning, this is the model that we obtain in order to calculate the PE ratio. So this is the model which is very much easy to calculate. With the help of this model, PE ratio is calculated by the investors, and then they calculate they calculate intrinsic value, and they make equity decisions. Again, this is another model for PE ratio where ROE is actually adjusted to. So whenever ROE is one of the major criteria for investment decision, ROE is adjusted into the model of the PE ratio, and this new model is been obtained for calculation of PE ratio. So this is simply in the cases where ROE is considered as one of the major factor for taking investment decision by the investors. So these formulas can be easily applied in the questions, and then decisions can be made for equity valuations. Similarly, this is the last portion of the topic where we will discuss how preference shares valuations are been done. In all the models that we have used previously, equity valuation was considered. Now this is the case where the investors, they want to invest into preference shares. So this is the model which is used for preference share valuation, and then again the model, the formula is very, very simple. The formula is P0 is equal to D divided by R. Now D divided by R, because it seems here the factor G is not considered, that is growth rate is not considered in the preference share valuation, and you already know the reason, because preference share are fixed income securities, that is the dividends on preference shares are fixed, and that is why growth rate has no meanings in preference share valuation. So the formula is very, very simple. The P0, which is the intrinsic value, is dividend divided by the required rate of return. By using this formula, you can actually calculate the preference share valuation. So this is one of the example for your reference, that how this model is used for equity for the preference share investment. So this is the question which has been given, dividend value is given, and you have given the required rate of return. Simply dividing the dividend with the required rate of return, you can obtain the value of preference share, which is the intrinsic value. You can compare this value with the actual market price, and you can take the investment decision. This is another example again for the calculation of preference share valuation. So with the help of these models that we have discussed in the chapter in this particular topic, I would like to conclude with the notion that these are some of the widely known models which is actually used by the investors for equity valuation, and similarly it is also taken into consideration when preference share valuation is been done by the investors. So you can use these models very much easily, and you can take investment decisions on the basis of the comparison of intrinsic value with the market value, and you can take buy or selling decision. So thank you so much.